My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. And joining me today is Thomas Cole, co-founder of Distillate Capital Partners, which is an ETF issuer focused on value and quality. Tom, it's so great to have you on the show, and I want to start by asking you whether you feel vindicated by the collapse in those really frothy, speculative parts of the market in 2022.
I've been through enough different market scenarios, and I can't say that you can ever, want to be in a position where you're celebrating someone else's loss. There are always things in the market that don't make sense. People that wait for normal times typically wait a very long time because we seem to go from kind of one episode to another. And on top of that, I would say that the market's really very perceptive about change. You saw that in 2020. They recognized that the world was going to be different because the pandemic, for the first time, really made remote working possible. And so it's no wonder that investors flocked to ideas that were going to benefit from that. But it ended the same way episodes like that always end, and that is when the market wants an attribute and stops thinking about what they're willing to pay for it, it typically ends badly. That happens in a micro sense. Sometimes it happens in a very big way. You could argue that that's exactly what happened in the late 90s when 60 or 70% of the market was being driven by internet-related stocks.
Do you think that we're at the start of another big cycle where value outperforms growth in the broader market?
It's a great question, and it's one that I think has got a lot of investors' attention. But our answer to it is a little different than I think you might typically hear, and that is that we don't think value really ever stopped working. I mean, there certainly are periods of time when the market disconnects from the underlying fundamentals and fundamentally driven strategies like a valuation strategy struggle. The issue with value investing is really one about the way measurement is done, valuation measurement. And the issue behind that is the change that's occurred in our economy over the course of the last couple of decades, the fact that we're now an economy largely driven by R&D as opposed to physical assets. And when you get into the accounting pronouncements, the way those activities are accounted for on corporate profit and loss statements is completely different. And where that leaves you is with metrics like price to earnings and price to book ratios that are no longer comparable across the investment universe. And that's important in the context of value investing because the constituents that come into value benchmarks are driven very often by price to book ratios, or at least there is a very heavy weight on price to book ratios in the constituents and value benchmarks. And where that leaves you is with a couple of industries in value space, as it's currently defined, that typically have a very heavy hand or a very dominant position in those benchmarks. Those two things in this case, and it's been true in most of the last decade, are financial stocks and energy companies, which both have meaningful accounting book values, which render them with low price to book ratios, and they therefore dominate the price, the indices that are value focused. So your question about will value continue or what's the story with value, it may in fact not at all be the case that we are returning to an environment that cares about what it pays for stocks. I'd argue that people have always cared what they pay for stocks. The returns in 22 were not necessarily a return to a style or a return to the idea that people cared more about what they paid for companies that were in the value benchmark. It is more, in our view, a case where the coincident outperformance of energy and financials, which again are two big chunks of that benchmark, both coincidentally did well. So, if the following question is how will value fare from this point going forward, In fact, it may be more important what happens to the industry drivers for energy and financials than it is thinking that this is a return to a style in the marketplace.
That's a great segue to now talk about your flagship fund, DSTL. Tom, you've hinted at the flaws within the value benchmarks, how they look at things like price to book, which might not truly capture the worth of a company. Is that the reason why DSTL is doing so much better than other value ETFs?
Certainly the value benchmarks are problematic in the context of thinking that they are difficult to beat. I mean, it sadly is the case that you could argue that they are artifacts of accounting rather than a really good representation of stocks that are trading at a low price to worth. So we think more about the S&P 500. And the drivers of returns for us are a couple fold. One is that we think we measure valuation accurately. We utilize free cash flows rather than earnings or book value as a measure to gauge where prices are, and we buy the least expensive stocks. And that allows us to outperform in trending or up markets. The other element of what we do, and it's been true over the course of the time that we launched in 2018, is that we protect capital during down markets. And that's a function of the way we think about risk.